Good afternoon, everyone. Good to be here. Bazaar mein tezi hai with index being at all-time high. I can see so is the case with attendance in this room. I think for any investing event in Delhi, this is probably the largest crowd I have seen in my limited experience of 13 years. So good to see rising interest and participation in equity. Just out of curiosity, can we show by raise of hands how many of us have joined markets in last 5 years? Okay. And for how many of us this is the first VIP? Quite a few. Great. So the next session is on cycles from somebody who has seen plenty of them. He's been in markets for 33 years. That's longer than the age of a lot of people in this room. So that's an apt topic for somebody who's been in markets for that long. I've been given the opportunity to introduce Mr. Shyam Sekhar. He doesn't need an introduction. As I said, he's a veteran in the markets. He's come all the way from Chennai to address us. But as the job demands, I'll briefly read his profile. So Shyam Sekhar is a chemical engineer by education. He began investing in his last year of college in the year 1990. He joined his family business while simultaneously pursuing his interest in equity investing. He started the first equity research desk back in 1993 and developed a proprietary growth investing framework. He emerged as an aggressive investor and a significant shareholder in several companies over the next few decades. He was the president of Tamil Nadu Investors Association between 2012 to 2015, and during his leadership, TIA emerged as a nationally recognized investor body by holding national level investor conferences. I thought a financial services firm was bootstrapped by him in 2009 and has emerged as the fastest growing investment management firm from the South. The firm manages 4 investment strategies that are consistently beating their benchmarks since inception. An active handle on Twitter, regular columns for money control, multiple YouTube channels in Tamil and English distinguish him as a well-recognized investment thinker and opinion maker. He was featured in the best-selling investment book, Masterclass with Super Investors. Please join me in welcoming Shyam bhai to stage.
Good afternoon. I have the difficult task of speaking to an audience after lunch. Whenever I sit in that audience, I know how difficult it should be. In this 1 hour, I will try to give you some of the things that I learned along the way and how my learnings helped me improve as an investor. Firstly, unlike our previous speakers, I have never worked in the investment industry. I've never held a formal job anywhere. And secondly, I've been an entrepreneur running a manufacturing unit for nearly 22 years. And subsequently, I joined the investment industry in 2009. So most of what I learned was as an individual investor, and I value those learnings immensely. And I think those learnings have definitely helped me significantly even afterwards. I deem myself very lucky that I graduated in June 90 and I joined the market almost before that, a month before that. I had no idea that I was going to become an investor. Unlike many of you who are very clear in your aspirations, you're doing your exams, you're very focused, I had no idea. I used to spend time with my neighbor who was a chartered accountant of many reputed companies in Chennai, and I used to see him do his investing. That curiosity made me learn a few things, and I had a lot of time. And it was that phase of life when you are not sure what you will do other than be a part of your family business. That is when I got hooked to equity investing. By nature, I had a fairly good understanding of how consumption works. And my natural inclination was to buy better businesses because my investing was not supported by my family. Everybody were against investing in equity as an asset class at that time. Investing was seen in a very different way from how it is seen today. So I simply could not afford to lose money. If I lost money, my story was over. So I had to invest in quality, and I had some idea about consumption. So the first companies that I invested in were quality stocks. I bought 3 stocks which basically helped me believe that I could do investing. The first one was HDFC Limited, it was a 100 paid share. The second was Ponds, which later became part of Hindustan Lever, and the third was ITC. These 3 companies were the companies that I bought first, and subsequently all the companies that I studied were Cadbury, Reckitt, Procter & Gamble, Gillette, all very safe companies because that was the place to be. But when you're young and learning something and you have the fire to learn, you start interacting with a lot of peers, and those peers have a very different worldview. The friends I had were doctors, so they started talking about pharma. There were people who were investing in Sun Pharma at that time, and I had no idea about that subject. It was very complex. But still, you start exploring new things. And then I had other friends who wanted to do only value investing and study only brick and mortar businesses. So I would go along with them, and we would study companies, and we would visit companies, do a lot of scuttlebutt, and that basically gave me my first window into value investing. And we had time on our hands every evening from probably 5 till about 11 or 12. We would be only discussing markets, trying to read whatever we could gather. The papers used to come in the evening. The pink papers would come only in the evening, and that's how we got our experience or knowledge. So there was always a lag between what Bombay knew and when we knew those same things. There was a lot of scuttlebutt we used to do. At that time, it was just the beginning of liberalization. Within a year of my coming into markets, you had 3 things. You had delicensing. A lot of industries were delicensed, which meant that companies could increase capacity significantly. And there were a lot of industries which were changing dramatically. Exports were going to boom because of the kind of incentives we had. You had the balance of payment crisis. The country badly wanted dollars. So a number of themes started opening up. So it was a very good time to do scuttlebutt, visit companies, understand who is into exports, who are going to get those incentives, and try to form a view on multiple businesses. So the period up to May 1992 was a very exciting phase because we could visit so many companies, we could learn about industries, and there were no constraints. Unlike people who work in an industry or in a asset management company like you do today, you are only going to do what your firm wants you to do. We had no such constraints, so we were free to see whatever we liked. So it was a very free environment in which we learned. But 1992 was not scary. It was something which is indescribable. It's beyond description, because what happened in 1992 May was a crazy thing. And most people who saw us take interest in stock markets were kind of coming to us and saying, see, I told you, this is not the place to be. After May 1992, the Harshit Mehta crash. So it was so traumatic that my mentor told me that you should not do any trade for 1 year. So from May 1992 to 1993 June, I took a sabbatical. I was in IIM Bangalore doing a 1-year management development program. But there also, I was busy learning equity research. That's the first brush I had to a lot of literature on equity research. The IIM Bangalore library, as you all know, is a fantastic place to learn. So I was able to do a lot more structured learning in that 1 year. And when I came back, I decided that I would set up a proprietary equity research desk, because I didn't have a choice. I still had to run my business, so I could not join any company. Chennai was not a place where there were people who were willing to, employ anyone as a research analyst or advisor or consultant. Those were not the days when people would pay you for research. So there was no question of monetizing what knowledge you had. So the only option I had was to set up a proprietary desk and do my own research. And that's how this journey got a little bit more formalized. But it was a very, very good phase to learn, because during those few years, I came in touch with many peers with whom I still remain very close. One of them is Mr. Anil Kumar Goyal. Subsequently, Sanjay was another person with whom we started interacting in 94, 95. And we used to form a small group and exchange our ideas on multiple industries, more oriented towards the value style. So that was a phase where I was deeply into value investing, because again, it helped me not to lose money, it helped me to survive, and those were very, very difficult times. 95 to 99 was probably a very, very tough phase, because 90 to 92 it was very easy to make money. We got out of the Harshad Mehta scam with minimum scratches, not even bruises, and kind of saved ourselves out of that. But 95 to 99 was a very, very difficult phase to make money, because the markets are going nowhere, valuations are very, very low. But it was a very good time to learn a few things. One, how do you develop simple principles by which you evaluate businesses? How do you study sectors? How much can you pay? And we were a very, very tight-fisted group of investors. So we would buy companies very, very cheap. And that 4-year period basically taught us a lot to buy businesses cheap. Then you had the 2000 tech boom. Interestingly, in 1992 and in 2000, I had not participated in any of the sectors or stocks which were in the boom. For example, the tech boom passed without my buying any tech stocks. I was completely out of the tech boom. I never invested in any tech company, because the valuations were much higher than what we were comfortable buying. We were buying stocks at very, very low PE. It was unthinkable for us to buy an Infosys at that time. We never went anywhere near that. Similarly, we were completely away from any of the Harshad Mehta stocks. So that habit has stood to this day. In every boom, we have not participated, whether it is the 2008 boom or in 2018, we had exposure to some of the sectors which really did well, and like teams like small caps, because that is where we have always been. But even there, we were trying to get out. We were not trying to participate in the boom. So generally, my tendency has been to stay away from sectors where there is too much froth, where there is too much excitement in the market, where people are very, very excited and willing to pay a higher multiple. This tendency is what I think has helped me survive this long in the market. And this tendency has also made me look closer at companies, evaluate their financials on a continuum, take learnings in one cycle to the next cycle. And this phase between 1990 and 2000 was very, very important, because the number of companies that we would have studied closely was very, very high. The number of companies which we tracked during the decade was also very, very high. It is very unfashionable today for people to track so many companies, but those days we did it. I don't know how we did it, but we still did it. And that basically taught us so much to think beyond the immediate also. When you buy companies very cheap, you also try to see how the value will get released. There were so many businesses which were expanding in that phase continuously. There were so many companies which raised capital at high prices in 94 during the GDR boom, and then lost 90% of the value by 99. You will be surprised that most of the companies of very, very reputed groups of today, like the Murugappa group, were a part of this. And we were tracking all these companies from 94 all the way to 99. That's why I said that phase was a very, very important phase for us in learning. And we were able to think beyond the immediate and buy those companies when the valuations came down. So despite not participating in tech boom, we were still able to make money in the stock market. Now, today we say contrarian investor, we give nomenclature, we try to box people into stereotypes. But this decade was a time when we did not worry about any stereotype. We were very free to learn what we like, and that learning has helped immensely subsequently. In fact, we never thought about how it will help. But looking back, that learning helped us a lot. Another important thing we learned between 95 and 99, and I credit Mr. Goyal a lot for this, is to think big. How do you buy a lakh of shares in a company? How do you put 1 crore in a single stock? How do you buy a significant position in a company? How do you buy 1% in a company? All these thoughts we were able to try out, and as a very, very young investor, I was able to try it out for two reasons. One, because of the constant engagement with him, and the second reason was that stock prices were so low that we were able to buy quantity. Today, if stock prices and valuations are so high that you have to put out a lot of money to buy large parcels. Then it was not so. It was very easy to buy large parcels and to learn how to scale our bets. So in that sense, that was a very, very important phase, 95 to 99. Then the tech boom happened. We had no tech stocks in our portfolio, but that did not mean that we were not punished. We were definitely punished because post 2000, our stocks also fell, and in fact they fell more than tech stocks. But this phase helped us a lot because we learned to scale bets, we learned to right size our positions, and probably that is also the phase which taught me to do portfolio construction. Today I see a lot of people very keen to know which stock to buy. I think that's very normal for people in the first cycle. For me, in the second cycle, what I learned was that you should learn portfolio construction and pay as much attention to that as you pay to stock selection. And that phase definitely helped us. That long bear market was a time when we learned a lot, experimented with growth style of investing where you bought quality stocks, experimented with value style of investing where you bought cheap, but those stocks also turned out to be growth stocks in the future. So what you learned helped you a lot later when those businesses accelerated their growth. So this phase between 90 and 2000 was a space where I had a lot of freedom to practice and evolve both the styles and understand how much each one works for me. By 2000, I was not clear still what style I should do, and I was still doing both these styles. I would say that the period from 2000 to 2010 was when I was able to evolve a little bit more than the previous decade. First, I started organizing my thinking. I started to simplify my thinking into themes, which helped me to focus on a few things. Some of the simple themes at that time were fertilizer. There was an imbalance in fertilizer. We started looking at fertilizer. We started looking at how to participate in industrial stocks without buying capital guzzling companies. So we bought many of these consumable businesses at a very early stage. Organizing your thinking is very, very important. I think a lot of us are today going behind themes which are very popular, but it's not just important to organize your thinking into themes. You must also look at themes which are not popular and spend your time when they are unpopular so that you will be ready to buy them when they must be bought. You can't start thinking about a theme after it has run up significantly. And I see that a lot of people are doing this, but this was a phase where the markets gave us time and it was a very, very early stage to think themes. I'll give you an example of two themes which I ideated at that time. One was the chemicals theme and the other was kitchenware. So there was this stock called TTK Prestige, which I think did an IPO at a market capitalization of somewhere between 130 and 150 crores. And in 2000, 2001, the market cap fell to 21 crores. That was the market cap of the company. The revenue was close to 100 crores. The market cap was 21 crores. I felt that the kitchenware theme was very, very early because until then TTK was seen only as a company which sold one product, pressure cooker. Whereas they were selling in America kitchenware, which was not so successful at that time, in fact, but they were developing the expertise to broaden their product range. Even today, when you compare TTK and Hawkins, you will see that two exceptional companies. One company has lagged for 22 years in the kitchenware theme, while the other has managed to move well beyond that theme. So this is something I could spot at that time simply because I could organize my thoughts into a theme and then go and do a lot of scuttlebutt, meet the company, understand what they were doing, and we were able to buy large quantities of this stock at that time. I think we must have bought close to 3% of this company for 63 lakhs. That's all we spent. And the seller was Morgan Stanley. It taught us how to buy a large parcel of a stock even when there's a very, very important and reputed institutional seller. but we were very, very early. The company continued to overpromise and underdeliver. I would have held the stock for about 3 years, and in 2004 or 5, I would have sold it around 80. This is another point that I want to emphasize, that in every market cycle, you have to extend your gestation of ownership. This is something that I have taken a long time to learn. In the first cycle, I would have held a stock for something between 2 to 3 years. In this cycle, I would have held between 3 to 5 years. And slowly with every market cycle, I have managed to extend the period of ownership, because time is the differentiator in returns. Two people would have bought the same stock. Somebody would have identified the stock. He would have held it through the most difficult phase. But the other person would have come in after this phase and made multiple times more. I gave you this example so that you understand how to deal with an investment if you are very, very early. And this is a problem which, if you are very individualistic and if you are a very, very independent thinker in the investment world, you will constantly face this problem. You will be early and you have to learn to deal with that process. You have to learn to deal how to manage yourself. Another important thing which I want to say, and Mr. Bhattacharya mentioned in the morning that growth and value are conjoined at the hip. If you are a value investor, it's important that you find growth in the stocks that you buy. That is how you will be a very successful growth investor. I don't think the two schools are different. You start as a value investor and stay long enough to be a growth investor. This is my personal belief. So finding growth in value happened here. I mentioned TTK Prestige. There's another stock which I bought. I bought it for 24 rupees and it came down to 13 rupees, 10 paid. This was SRF. Sanjay is very familiar with SRF. A lot of work we have done. There was a demerger and then a merger, so many corporate actions. We were so early in this stock that after we bought, the stock lost almost 30-40%. We were not wrong. But dealing with being early is a very, very important learning for an investor. You need to learn how to deal with yourself if you're early in an idea, because you will always be early and you must learn to deal with that. And that is something that I learned in this decade. And finding growth in value is the only way you can become very rich. If you are going to be a value investor who is going to buy an undervalued stock and sell it at fair value, a lot of which we did in the previous decade, you are not going to become very rich. You have to participate in the growth phase of that business, and that's not easy to learn, because you need to extend your investment gestation and you must evolve your investment process to support that, because if you don't have a process to support it, you're going to run out of patience. You want to sell and find something else. And this is something which you cannot avoid as an investor, because you also have to show returns to yourself. Your confidence has to stay the course and make you do new things. So managing yourself is very, very difficult. And this is something I learned during this decade. Style is also something that you refine. I told you that I did a lot of quality stocks in the beginning, growth stocks in the beginning, then went to value stock, then understood that actually the value stock can also be a growth stock, and then try to find how I can stay long enough. I stay 3-4 years, still it's not enough. Then you understand that you sold and it was not the right thing to do. But you keep refining your style. You start finding what suits you, because you want success. You are able to ideate, but you still need to get the fruits of ideation. Because I have seen friends of mine, and it's a very sad comment to make. There are people who are much better at ideation than many of us, who are not in the market today because they were so early. I'll give you this example. There was this friend of mine who discussed Sangvi mover in Chennai. He discussed it so early, made a loss and got out. Sometime later in 2003-04, I again came across this company. We were discussing it with Mr. Goyal, completely convinced that it's very cheap to buy, and it was the only way we could be comfortable playing the infra boom. I went back to this friend and told him, you told this idea. Now we believe it's a good one. What do you think? He was so defeated that he even refused to look at the idea. He felt so defeated because he had made a loss, he had exited it, and this can happen to any of us. So when you're early, it's very important that you have a process and a style and a confidence which will support you till it is the right time. We made so much money in that stock. But just understand, the person who ideated the stock made no money. He made a loss and he quit. This can happen again and again, and this phase taught me that. It taught me to be humble, because I went to this person, I spoke to him, still he was not having the confidence to go back to something which he had done. The market is such a tough place to be, and it can humble. I know a lot of people are almost first timers in this cycle. You have not seen something like that, but trust me, you will see that phase. And when you see that phase, you have to apply yourself adequately. I know a lot of people try to say that I am a growth investor, I am a momentum investor, I am a value investor. I think that one should not stuff oneself into any of these silos. It's very important to understand how you can straddle both worlds, because one world leads to the other. The reverse also happens. I'll give you an example. You may have a stock which is a growth stock today at a very high multiple. Mr. Sudram mentioned that Infosys was at a PEG of 100 PE in 2000. In 2016, I bought Infosys at 12.5 times because I saw it as a value stock. The same Infosys which we avoided in the peak of the tech boom, we were able to buy it at 12.5 times and still make money. So a growth stock can very well become a value stock some other time. I don't know how many of you are aware that through the Harshad Mehta boom and even for a much longer time, Castrol India was a growth stock. Today, if I tell you that Castrol India was a growth stock, you will laugh, because most people think it's a value trap. In the 90s, if somebody said that Castrol India would become a value trap, everybody would have laughed at us. But that's the market. The market turns growth stocks into value stocks and value stocks into growth stocks. So you have to straddle both worlds and be comfortable, and I learned this in this decade. And because you're straddling these worlds, both these worlds, your portfolio strategy keeps shifting. Also, your portfolio strategy keeps shifting because there are times when you want to be super defensive, and there are times when you want to lower your defense and become a little bit more aggressive, and there are times when you want to go back to being defensive. This decade was a classic example, because 2001 to 4, we were very deeply entrenched in value, and 4 to 7, we went back to growth, and back 7 to 10, we were so scared after 2007. I remember Sanjay had invited us to Bombay for Professor Bruce Greenwald's lecture. And in the lunch break, we were talking, and Mr. Goyal was telling me, I think we should not be sitting here, we must be selling whatever we have. That day was the peak of the market. The day Professor Greenwald spoke was the peak of the market in January 2008. We were in value stocks. We were very scared of the market at that time. But still, when the market crashed, our stocks also fell. So this decade basically gave me an opportunity to scale up investments. I started buying significant positions in companies and being comfortable about owning larger positions, taking bigger bets, creating a portfolio construct to my work, being more balance sheet driven in my investing. And I think that this was the best learning phase for me. These 2 decades of learning helped me in the next decade. How? Let me explain. In 2010-11, I had a very defensive portfolio, and I went to an AGM in Bangalore of a company called Adar Fontech. A friend of mine, he had just left Sequoia. He was one of the early friends in equity research in Bombay. So I told him, why don't you come to the AGM? So he came to the AGM, we sat through the AGM, and then I told him, let's go and have lunch. There's a Taj Gateway nearby where I like a particular restaurant. So I went to Karavalli, which is the restaurant, and we were having lunch. So I opened my portfolio and showed him the portfolio. It had all the value stocks because we were scared of losing money. My friend asked me a question. He said, you have done 2 years in the stock market. We are in a bear market. If you can't be aggressive now, what is the use of your spending 2 decades in investing? And I can tell you that was the best lunch I've eaten in my life. Not only it was food for the stomach, it was food for thought. So I told my friend that I will come back to you with something else. That's when I was able to seamlessly go back to growth investing, and I wrote a portfolio and again sent it to him after a week. I sent him a portfolio at sometime 11:30 in the night. He called me immediately, selling all those stocks. I sold my entire portfolio and built a growth portfolio. Where this really helped me was not just in moving quickly from value to growth, but also understanding how to play it. It was a classic moment because at that time the macros were getting worse and the micros, the valuations were improving 2011 to 13. So I was able to sell my value stocks at reasonable price and slowly shift that portfolio back into growth. The important thing in this phase is that I was able to extend my ownership longer. So I held stocks for at least 5 years and I bet only on growth stocks. It was a concentrated portfolio of 7-8 stocks, and I did only a classic buy and hold until the valuation reached a level where I was very uncomfortable owning. Until then I just held it. I didn't worry about valuation going above the usual value stock paradigm. I held it comfortably like you hold your FMCG stocks, and I made fewer decisions during this period, and all this helped me because I held the stock long enough. But there was one problem. I was able to sell some of these stocks, but I had huge challenges selling the micro caps because I am not used to selling large parcels to institutions. I have no idea how to sell to institutions, and I had grown significantly, but I had no clue how to exit. So 2018 was a very interesting phase where we were able to sell the bigger stocks, but not able to sell the smaller stocks. So micro caps became a headache. Also, I had not thought about all the attention that you will get. Wherever your name is in one shareholding list, somebody tweets about it, somebody asks you 100 questions, and I am not used to that kind of attention as an investor because always my investing has been away from the public glare. So it was a very difficult phase where you are successful, but still you are not having the freedom which you had as an investor. But this decade taught me to use what I had learned in the previous 2 decades. And also, reinvestment became a huge risk because you have to invest much more capital in just 1 decade. So the process demands were very high, and I had to adapt my process. So I took a clean break from all this, and I decided to do 3 things. One is that I created a clear collaboration construct with very well identified people with whom I could work. So a lot of young people, we started working together on a newer way of doing research, and that is something I really enjoyed between 2018 and 2020. So I learned how to work with others, accept ideas from others. And the second thing I learned is not to be the elephant in the room. So I decided that I will not buy very small companies where you hold very high positions, because when you build a 2-3% position in a 200-300 crore company, there's a high impact cost, and after that you are stuck if your decision is not working out or if you don't like the company. So I didn't want to do that. So I decided to avoid larger holdings in very small companies. And I also decided to vacate my home ground at that time, which is micro cap and small cap. So from 18 to 20, I spent my time selling my legacy portfolio. That's exactly what I did for those 2 years. So in that sense, I was completely unprepared for COVID. I was completely unprepared for that event of COVID, and it caught me off guard. But I want to summarize a few things which I learned up to this period, which have helped me in this phase and after. The first thing is something I learned through our discussions with Mr. Goyal, Kaushik, my brother, Sanjay, all of us, and that is trying to time too hard. It doesn't work. This is a graph we just developed like a clock. You can just see which is the best time to buy or sell a stock. This is something which is very important, which any young person should know. I want to place this point very emphatically here. So we all think that the best time to sell a stock is at the top, which is at position A, right? But most people sell when it is either late at position B or at position C. So then you come to which is the best time to buy. I would think C is a good time to buy, okay? But people want to buy at the bottom, which is D. Nobody does it. Most people end up buying at F, by which time it's probably not the time to buy, right? So theoretically, the best time to buy is when it is a D, but it is difficult to execute. You may not get the volumes, at that time your conviction may be low, and most of us move our price target lower when the price is at the bottom. It's a natural instinct for us to do. So we learned that you should buy between C and E, and you should sell between F and B. This is something which gives a lot of peace of mind, and your process keeps running smoothly, and you are not trying to be perfect, and you build the desired positions. Why I am putting this before you is it's very, very important to right size your positions. Most people end up with smaller positions because you are trying to be perfect at the bottom in buying, and you end up not selling even your positions which you built with great effort because you are trying to be catching the top. So I think that you should know when to buy and give yourself more bandwidth, and you should also be willing to start selling a little early so that you sell at the top and even after the stock has peaked. So this is something which is very, very important, which I learned in those 2 decades and which I have been using subsequently, which helped me a lot when I have to build larger positions either as an individual investor or as a professional investor. This next one I want to talk about is very, very important because we worship success. We take success for granted, but we don't see the genesis of success, because see, there are times when we buy a bad stock and we lose money. It ends up as a losing bet. That's the first quadrant. Well deserved. There's nothing to regret. You made a bad choice, you're punished. But there are some times when a bad bet becomes a winning bet, right? There could be people who made money in Brightcom. There could be people who made money in a Suzlon. There could be people who made money in stocks which don't hold on to value, right? There you're lucky, but there's a problem. You start thinking that that's a way of investing, and you start going after bad bets simply because you had winning bets in bad bets. It's like kachra stocks make money. There are people who give these theories, right? This is something you should not get in your mind, and this is something which went very deeply into our minds during those 2 decades. Then you have the good bet, which is a losing bet, right? In the sense, you could have bought a good stock, you could have waited 3 years and then run out of patience, you could have sold it, maybe to buy another stock which you thought was better, and then this stock which you sold becomes a winning bet. That is something we should avoid through our behavior. We need to extend the gestation of ownership. We should be willing to wait longer in businesses where our conviction is high. We should not lose patience simply because time has passed. And it's important for us to identify most of our investments, not all, you can never get all, but a majority of our investments in the 4th quadrant, which is good bets and winning bets. I was very lucky that the 2 decades of work which I did helped me in the 3rd decade to land multiple stocks in that quadrant. And if you ask me what I would ask, I would not even look at performance. I would want to be in that quadrant. That's all I would want. If I am focusing on that quadrant and I am able to find investments which will keep me comfortable till they are successful, that is enough. I know a lot of us obsess about performance and outcomes. I think if you are able to focus correctly, then the outcomes are a question of time and we should wait. These are 2 points that I learned during those decades, and a lot of my learnings came through collaboration with peers. And interestingly, the peers whom I collaborated with are not echo chambers. For example, Mr. Goyal is a very tight investor when it comes to valuation. He would never overpay, and very, very rigid frameworks of what is the right value, and he would adapt his framework mildly. Sanjay, as you all know, I don't need to tell you what is his style. His style is very different. My style is very different. Naren had a very different style. There are other friends with whom we have collaborated over these decades when they were individual investors who all have different styles. Most of the learnings happen when we interact openly with people who are not our style. I hate to work with people who agree with whatever I say and say this is good, that is good. This is not like you're praising the cooking of somebody at home or getting praised for something which you do at home. It's not a mutual admiration society, it should never be. Your peer circle should be completely diverse with people who will criticize you, people who will even scold you. It should be very, very open, and you must be able to exist comfortably in that society and take that criticism. The reason I am here till this day is that the earliest part of my investing career, I had friends who were very, very harsh critics. They were very, very harsh critics. The way they would deal with an idea would be very tough. To convince them would be very difficult. So to convince them, you work harder and you build your idea well enough before you speak. You don't open your mouth when you just got the idea. Until you form the proper hypothesis, you don't go out and speak. So the peer circle is very, very important in investing. And I think that today there is a tendency to only move with people who are our type. I think we should move more with people who are not our type. Now coming to the phase which I would think was a tough phase for me, which is the COVID phase and beyond. As I told you, I was completely unprepared for COVID. I had not factored this in. I thought I was going to complete my restructuring and start a fresh portfolio and do things. And we had just started our PMS. We got our license in August, and we had just gotten a handful of investors, collected very little money. We finished deploying money in the last week of February, and March COVID hit. So we were completely unprepared for that. And also, COVID brought a certain disruption in our work, in the sense we are not used to working remotely first. Like, we're used to working face to face with people. And there's a personality thing in this, some people can't work in such environment. I am one of those. To top it, I moved to Kodaikanal. I took permission from the government and moved to Kodaikanal, and I was living there, so which is remote. And we had some health issues in the family and all those things. And that is the time I felt that, okay, I have been investing till now, thinking that I am around to manage a portfolio. What if I am not around? That thought completely took over my mind, and I started reimagining my investing, and I had a complete change in my mindset during COVID. I know a lot of people are busy making money in that phase. I'm not one of those who was active during the COVID phase doing anything. We were just studying businesses, trying to understand what would happen later, and just taking stock. Almost the entire lockdown, that's what happened. After the lockdown happened, we had some clarity. Started again reimagining my personal investing. Luckily, in the PMS, we had very rigid rules, and that's where my basic philosophy of creating products and not making the PMS personal worked. Generally, in the PMS space, every PMS product is identified with the personal investment philosophy of the manager. There is no distinction between the two generally. Whereas you won't say that of a mutual fund. What we wanted to do was create products which would compete with the mutual funds. We were not competing with the PMS industry. So that helped. So the PMS was isolated, and I had time to reinvent what I wanted to do. And it was a very, very interesting phase, because I was started looking again at extending the investment gestation. Here again, I had done a lot of private market investments before COVID struck. And there again, there were huge challenges. I had invested in a travel company in 2018-19, and 1 month before COVID struck, the company hit the highest turnover, and it became profitable in February. We used to have monthly board meetings. In March, we were expecting the company to hit a new high. Business went to zero, and the company needed to be recapitalized. So it was a very, very interesting phase of personal learning for me, because I learned to deal with a crisis for which there was no preparation. It came out of the blue, and it was a space where I was intending to do a lot more. Interestingly, what we did in that company taught us much more on investing than I have learned in the previous 2-3 decades, because an equity investor is an opportunity seeker in the secondary market. You are not a business builder. If something doesn't work, you are going to sell and get out, right? You are going to just sell and get out. That is going to be your response. But here, there is no question of selling. The value is zero. You have to rebuild the business. How do you rebuild the business? You have to recapitalize the company. Not only recapitalize the company, you have to bring the right strategic thinking so that the company survives the crisis where there is no revenue for 6 months and there is expense, and then build market back. Interestingly, last month, the company did revenue equal to 1 year's revenue at the time I invested. It did monthly revenue equal to the annual revenue at which I made my first investment. So these things really shaped my thinking a lot, and I started thinking, how can I own businesses much longer? Before COVID, I would think that if I'm able to own a business for 5 to 6 years, it would give the desired returns. But after COVID, I decided that I would think of what I can own for 10 years. And when you move from 5 to 10 years, most companies which you want to buy or you think of buying don't pass the test. Most of the companies go down. Fewer companies think deeper, think longer, your decision making process takes time, but your investing is slow paced but oriented very firmly in a certain direction. So that is what I learned from COVID, and my focus has been venturing deeper into the private equity space. I again invested in another company which is a food chain. We invested in during COVID when the company had shut most of its restaurants. We gave capital for the reopening, and that company has also done extremely well. It's turned profitable since we first gave an investment. They did another round, and today the company is profitable. I learned a lot more during COVID than I have learned in my previous 3 decades. These 3 years taught me a lot more because I realized that whatever entrepreneurship I had done suddenly became valuable. I realized the value of those 22 years I had spent running a manufacturing company during those 3 years. 2010-11, the valuation of companies which I picked up large stakes were all 100 to 300 crores, whereas now the companies that I pick are probably between 2,000 to 5,000 crores, which is a very, very different catchment. But slowly I am adapting and learning how to invest at a higher scale. Why am I saying this, and how is it relevant to an audience like this? Because all of you are going to grow, and you always need to prepare for that growth. And you need to organize your thoughts in such a way that they support your growth as an investor. One thing that has always stood me in good way is the constancy of teams. I always think about teams and I always collaborate. If you take private investments also, I have a peer group with whom we collaborate. Each one brings certain strengths to the table. We don't have investment bankers in any of the transactions we have done. All transactions are direct with the founders, so we don't deal with merchant bankers at all. We deal directly with the promoters. So we seek businesses, and there's a lot of collaboration that happens, and that is something which is very, very important, because only through that we bring all our skills to build the business. And the whole thinking is oriented towards how can we build businesses. I think that investing, if to be taken beyond a certain point, has to be entrepreneurial. Even if you are not the entrepreneur, you have to think like the entrepreneur and be with the entrepreneur. Only then you can make a significant improvement beyond a certain point. Otherwise, your investing is going to hit a ceiling. Because otherwise, you're just going to say that, okay, now I'm going to do indexing or ETF. When you see a lot of investors who have spent 30, 40 years, and I've seen this with multiple people whom we respect. When the people whom you respect as managers retire and then tell you, I'm only doing indexing, what does it tell you? It tells you that beyond a point, unless you reinvent yourself, you cannot be relevant in this field for a longer duration of time. And this will apply more to the generation of people who are going to follow, because this reinvention will have to happen at a faster frequency than it happened in our time. So it's something that you need to think about and think like entrepreneurs. Don't be opportunity seeking to do transactions which will make you money in 2 quarters or 3 quarters, because that is not going to be sustainable. Because when the markets turn, if you have a phase like 95 to 99, which I think we will, that phase will sort you out and it will make you lose your faith in yourself and in investing as a craft. So be more entrepreneurial so that you can be with entrepreneurs and grow yourself. This is another important point that I have learned along the years, and this has helped me to protect myself. patterns and parallels. These are two sets of issues and events which you will see as I explain. First to the patterns. Very high promoter selling. A rush to do QIP. A lot of offers for sale. IPO mania. Insider selling. Employees selling. Lot of M&A activity. Promoters selling out of a company which you are very bullish upon to hold for a long period. Promoter sells out. And very high institutional ownership, very concentrated and high institutional ownership like mutual funds. And falling promoter stakes, where the promoter stake suddenly falls from 50 to 35. What do all these tell you? I am using these patterns today to highlight one point, that these patterns basically are warning bells to, for what? Can anyone say? It's probably a call to sell some of these companies. You have to be very careful. In a bear market, you can invert these patterns and you will have the other thing, promoter buying, no IPOs. You can just invert this pattern and you will get a bullish pattern also. In this case, these are warning bells to me. And if you notice, you're seeing all of this in the current market context. To me, I always look for patterns like these so that I am clear where the market is, and once I am clear where the market is, I get an idea of where I should be. Now to parallels. Parallels are more macro, behavioral in what the investor community does. Sectoral concentration by funds. Today funds are marketing only small cap and mid cap. Then you have these quant type of funds. Then if you look at funds closely, where their returns are coming from, it comes from very highly concentrated ownership in companies. I can show you mutual funds owning 9 and 10% in a company which has got only 25% public float. 40% of the public float will be owned by a single scheme or a mutual fund house. Now these things basically distort valuations. Suppose the same fund has a redemption pressure sometime in the future, he will have to sell. What you think as valuation today will, as valuation accretive or supportive today will become a weakness in the future, and the same company can trade at a lower valuation than it ought to. Today it is trading at a higher valuation. Then businesses going in for too much diversification. In 94, because companies were able to raise capital in GDRs, they did diversifications. They announced diversification plans and raised money and never implemented the plan. They put the money in treasury, they put the money in real estate. I won't name any companies, but if you go back and learn, you will understand a pharmaceutical company went into real estate. Why would they do that? Then they raise money saying that they'll do a project and then they'll put that money in their own companies. One company buying another company's share. And then they will diversify into businesses which they don't need to diversify. We see all these trends coming back in the QIP mania that you're seeing today. Then, because the valuations are high, you invent new paradigms of valuation like revenue multiple, PEG, EBITDA multiple. You're seeing all these things now. And as I told you, CapEx plans way ahead of what the company is capable of managing. If you take the chemical space, which was my favorite for a very long time, today you are seeing companies doing far more CapEx in 5 years than they have done in 20. What would all this lead to? Everybody thinks that they do a very big CapEx, then they'll improve the profit pool significantly. Actually, the converse can happen because the capacity has become so much, and one guy puts up capacity, competitor also puts up capacity. And once you have so much excess capacity, then the pressures are going to be different. It's not going to be a seamless utilization of high capacity. It's not going to happen. In fact, capacity utilization can even drop sometimes. So we are seeing all these things. These parallels give you warnings, and then thematic concentration by institutions. You have seen this happen time and again because people have bought only one sector, and Sundaram mentioned it. Mr. Bhattacharya also mentioned how people bought only one sector. I don't want to repeat what they have said. These are all parallels that we see in market cycles, which are very, very strong warning bells. And I think a young generation of investors and people who are like you, who are researching businesses and want to become professionals in the industry, must have your own warning systems. To me, parallels and patterns are my clear warning bells, and I always look at them and ask myself whether the risks are going up. Another thing which you generally see is when the macros weaken, valuations go up. Today you're saying that in the last few months that macros are slowly weakening and the valuations are going up. We saw this even in the rally that followed the 2008 crash. After there was a rally, infra stocks went up again and then fell again. I don't know how many of you remember what happened in 9, 10, 11. So we are seeing macros weakening, but valuations rising. That's again a warning bell. To me, parallels and patterns are very, very important because that helps me purpose my investment, stay out of where I should not be. Teams is something which always helps me because it helps me simplify my thought process, arrange my thoughts in a way which helps me make better decisions, simpler decisions. It's very important to simplify decision making. Teams help me a lot. And you have to think of and think through themes, which means that you must think of how things will play out in the future. I'll give you a small example. I got the idea to invest in Hudson Agro when it was 150 crores market cap, simply because I could see that just 50 to 75 kilometers away from Chennai, fresh milk was not available. People were selling to an aggregator. And slowly, processed milk was not only a city phenomenon, it was going even to rural. And these companies had negative working capital because they're collecting the milk, selling it and realizing the money the same day or the next day, and paying the farmer after 15 days. So when you think through how it works and how it can really add wealth to rural society, that becomes an investment idea. You can form any number of themes like these. I just gave you one example. I gave you the kitchenware example of 2001. Even today, that theme is relevant because maybe the valuations of these companies are not, at the right place today. But if you wait, a day may come when you will get these companies at attractive valuations which don't price in growth, because India will have multi-decadal growth, and if you are able to organize your thoughts in teams, you are able to invest for such a long period of time. When I see how people are holding on to some of the overvalued companies, the only reason that appears logical to me is that they don't mind those periods of overvaluation because they feel the growth will once again come back. Otherwise, there is no logic in holding a company at such a high valuation. If you take jewelry, formalization of jewelry is such a simple theme, where jewelry is bought for cash. I don't think that's going to continue for a very long time. I think jewelry is where milk was probably a decade ago, probably very early days. So these are all some simple ways in which you can think of and think through themes. Themes definitely help me to arrange my thoughts better, to not only arrange my thought, to rationalize, to go further and scuttlebutt and find out whether the rationale is correct or wrong, to validate. And simple themes are simply more powerful. You can really get maximum value out of them. Whereas we are trying to find out how an Indian company will be successful in semiconductor, I find it very difficult to understand actually. Whereas these simple themes are easier, and when institutional people come into the market and when they see the theme as maturing, money will chase these themes, and that's when your real returns will start happening. Until then, you have to wait. So you will have to only imagine how the future will play out, and that's not very difficult. You don't need experience to do that. You can always do it even if you are just 2-3 years into the market. So you have to construct a theme's future in the present, and that is something that has always helped me to be ahead of the market. The only area is you need to manage yourself till the market starts thinking the way you thought about it earlier. Enough time to think about an idea, to talk to industry experts, talk to competition, talk to customers, talk to suppliers, see how the process works in that industry, see how the business dynamics are, whether the company has a competitive position, whether the company has an advantage over its different stakeholders, and you validate the theme patiently and diligently. That is very, very important. And once you get confirmation, you should not be slow. Once you get confirmation, you must back your truck. You must build more on a theme. You must build your position, and you must make sure that your effort is rewarded. I know a lot of people who ideate a lot but don't participate at all. So they just allow ideas to come and go and marginally participate in them. The effort taken to build a theme is a significant one, the reward should also be high. So you must ensure that this happens. Now to what I think are my core beliefs which I have learned over these 3.5 decades. First, I think one should have his own philosophy of investing. You should own your investment philosophy. You can't live on borrowed philosophies. I think it's nice to appreciate what people before us have done. It's nice to know how peers are doing something, but you can't copy, you can't sidecar. So in that sense, I've stuck to this belief. My views have been strong at times on this subject, but I will always remain steadfast that you should own your own investment philosophy. You can't even have the same investment philosophy of your best friend, because he could be a different person and his way of investing can be very different. The second thing is, what is my philosophy? My philosophy is very simple. All investing is growth investing, and all growth investing is value investing. I don't think there's a difference in that. You should have a paradigm of valuation which you are comfortable with, and you should know what you are paying for, and you should pay value, and you should be patient enough to stay invested long enough to enjoy the benefits of growth. You should keep your ideation, investment ideation, free-spirited. I don't think we should box ourselves into narratives or very rigid opinions. I think you should have a very, very open mind, and you should not try to say that I learned this, so that's it, nothing more. You must be open to learning and unlearning constantly, because the world keeps changing, and you should keep your investment ideation very free-spirited. The most difficult part is you must protect your conviction, and that is where being in social media like Twitter or WhatsApp doesn't help at all. I think that you should know how to protect your investment conviction. Discuss your ideas only with people who will respect your conviction. If you are wrong also, they should have a way of teaching you how to reinvent your thoughts or how to reposition your thoughts. Don't be with people who will mindlessly destroy your conviction. There are many times when you have good ideas and somebody has talked you out of it. So you need to know how to protect your conviction. When you are very young, more people will be aggressive on you. So if you are a very young investor, it's very important to learn how to protect your conviction, because sometimes you could be ahead of older people like us. So you should know how to protect your conviction. And importantly, that doesn't mean that you should not coexist with the crowd. Learn to coexist with the crowd. Learn when to share your opinions, how to share your opinions, when you should protect your opinions, when you should grow your opinions, and when you should let your opinions count. It's very, very important that you learn all these things, because the earlier you learn these things, your evolution as an investor will be faster and you will be more comfortable with your evolution. Otherwise, the journey will be very rough. This is a very important point which I learned when my growth went ahead of what I expected. Sometimes you make a lot of money. Many of you would have made more money than you dreamt of in the last 2 years. This happens to everybody. It's happened to me many times, and good that you have made money. But remember one thing, when you make a lot of money ahead of when you should make it, it is your duty to grow yourself first and then handle that money. Don't think that success is a birthright and by virtue of your success, you have already grown. Your money has grown faster than it should have grown. It doesn't mean that you have grown. So you should always grow yourself ahead of your portfolio. So when you do that, suppose you have a 10 lakh portfolio, if you are going to think like how you would have a 1 crore portfolio, then your mental bandwidth will be much better. You will start thinking of slightly larger companies. You will start thinking of higher stability. I may have given a small analogy of 10 lakh and 1 crore just not to scare you. Just think if it is 1 crore and 100 crore, how your thinking has to change, because you will evolve from a very small portfolio into a much larger portfolio with every market cycle, and you need to grow yourself ahead of your portfolio so that when you are faced with the responsibility of managing that portfolio, either as a proprietary investor or a professional investor or somebody who's managing your family's resources, you will be ready. And it's very important for every investor to be ready ahead of time, and you need to reinvent yourself regularly, because the economic context is changing, markets are changing, investment beliefs are changing, valuation paradigms are changing. You cannot be rigid. So every now and then you need to reinvent yourself so that you're always ready for a new phase, for a new era. When does an investor start growing? When he recognizes his own inadequacies, when he recognizes that things are not happening the way he wants things to happen. When he recognizes the need to change internally, and he doesn't need somebody else to tell him that he needs to change, and when he responds to all these needs voluntarily, I think an investor who does this will definitely always be ahead of the crowd. We all admire Buffett and Munger. Many times we think that, oh, they said this at this point in time, look at what they're doing now. We respond in a very different way when we see their current actions by relating to their past utterances. What we are failing to do is recognize that at 98 and 93 or 99 and 94, they are reinventing themselves. It's such a remarkable trait to learn. Their core beliefs may be the same, but they are adapting to the market so nicely and investing in companies which they would otherwise have never invested maybe 10 years or 15 years back. I think that's a very, very important learning for us from who better? I mean, you can't think of somebody better than that to learn from. And adapting is very important because markets keep changing. If you're very rigid, you will not be able to adapt. In 2000, we were lucky that we found the other set of businesses cheap. Imagine the whole market being overvalued like now. Almost the whole market. I think a very significant part of the market is overvalued today. Then how do you adapt? So you must learn to adapt in every market context. According to me, the fact that I could adapt these 4 times has helped me a lot, and I think I will need to adapt far more going into the future, and that is my survival trigger. Otherwise, I would not be able to stay longer in the market. The one thing that I have learned in these 33 years is time is the differentiator. Investment ideation, names, stock ideas are much simpler. You have them. You all know what are the good companies. But it's very important to give them more time, learn to give them more time, which means you must do nothing about your investments. Your portfolio churn should be much lower than what it is as you grow. So which means time is the differentiator. And lastly, behavior delivers more beta. If you want to really beat the market, you need to bring superior investment behavior into your life. And these are my core beliefs, and these are what helped me survive this long. There will always be a day like this. You can check this date. It's 23rd March 2020. We will have days like this. And these were my thoughts. What happened to quality? It has lost so much value. What happened to value? It is being tested for quality. But it is for those days that we must prepare and live. I wasn't very well prepared for the date, but I know that if it happens again, I must be better prepared. And that is what makes me want to do investing for life. Thank you for the patient hearing.
How you encapsulated 33 years of your investing in those 70 minutes. And I probably say this on everybody's behalf, especially the examples you covered. I lost count of the lessons you had in those slides. It was remarkable to hear your journey over the last 30 years, over the last 70 minutes. So I have some questions for you. Meanwhile, if you haven't posted your questions, please use the QR on your table and you can let them come to us. Meanwhile, I'll just ask a couple of questions. So, Shyam, you touched a lot upon how your investing has evolved, what changed over each decade. I am very keen to understand what has not changed, what has stayed the same.
My fascination for growth, basically, whether it's personal growth or economic growth, social growth. I think I am always fascinated by how society changes and grows and evolves. And that fascination gives me a lot of fresh thinking. I'm able to see new things happen around us. And all those things eventually I'm able to bring into our investing also. So when you see society and you see a growing society, I think that always fascinates me. I'm always fascinated towards growth. That has not changed.
Would you also want to add certain things, certain lessons which you learned in the beginning, maybe things you didn't do and you would not do them even if you were starting today?
See, there are many mistakes you make as an investor, but they are contextual. When you don't have income, when you don't have fixed income, then you make faster decisions. You don't stay long enough. If I went back, I would probably start with a minimum investment gestation of 5 years. To reach that itself would have taken me a long time. Because until then you need to support yourself. See, most people here may be dreaming of becoming professional investors, salaried investors, those who work for organizations. They won't have the problems which people like me faced.
Right.
But even given my circumstance, I would think that I should have had a longer gestation.
Sure. So back in 90s, even getting an annual report used to take 6 months. You would only get printed copies. There was no internet at that time. So there was an information edge to people who knew, how to get that annual report. Also, even within that set who had the access to information, very few knew what to look at and what to focus on. Things like return on capital employed or things that really mattered. So people also had an analytical edge.
Correct.
Right? Today, that's no more the case. Thanks to technology, at a click of a button, all of us get the same information instantly, right? So we have tools like Screener and a whole host of other things where it's completely democratized, right? You also have analytical tools. So one thing is to have the information, the other is even the analysis is provided to you, right? So thanks to technology, the information edge and the analytical edge is completely gone. There is a good side to it and there is a bad side to it. The bad side could be you're bombarded with new information 24/7. Now for a long-term investor who's really thinking 5, 10, 20 years, probably 99.99% of all this is noise, right? At the same time, the friction which we had in 90s to trade is completely gone. If I'm not mistaken, the brokerage at that time was probably as high as 5%. Today it's free to trade, right? I have a mobile app, I get a negative news, forget all the research I did, it'll take me a second to just act on that because there is no friction and there is no cost to do it. Which is probably why market cycles are getting shorter. So the question is that for a lot of us who are investing now, who are starting our journey now, do you think it has become very difficult to have a long-term focus? And if yes, what would be your advice? How should one balance the pros and cons of this whole technology which has enabled good as well as the bad?
I think that people are checking their portfolios almost every hour now because they have it on the phone. I would think that a first step would be during market hours, never check your portfolio first. Don't see your portfolio during market hours. Second, any information that you receive, give a 1 or 2 day cooling period before you respond to it. Think through it, validate it, talk to somebody, see if somebody can give you another viewpoint. So don't react to what you get, whatever information you get. Buy an investment idea with a clear mental lock-in. If you buy, you should decide that you will not sell it for a particular period. If you are buying an idea for trading, it's a different subject. If you are buying for investment, buy a mental idea with a specific lock-in. I don't check my portfolio even every day. I see it over the weekends. Or when I have to do some portfolio construction related changes like, raise an allocation or something like that, when I have to buy something, that's when I refer to the portfolio. But I don't refer to the portfolio to find out its value. That is not the purpose. I think investors should stop doing that, and if possible, if you are keen to become an investor, don't activate the F&O feature in your app. Never go near options because you will never be able to get out of it once you get in. So these are some basic hygiene factors which you should bring into your investing. You should think through every decision. See, you have to stop yourself from impulse. That's very important. And I see that the way people judge, I'm seeing it in all the WhatsApp groups, right? Some company gives out some release, okay. Within 5 minutes judgments are delivered. I don't know whether how they read that also, whether they are thought through it. Are people such authorities on companies that they can just make a judgment within few minutes? They don't even give time. And if you are receiving those judgments, maybe on Twitter or WhatsApp or wherever, at least you give yourself time to think through it. Don't be reactive. Because when you're reactive, you start making decisions which don't need to be made, and you start making wrong decisions also. It's very important for an investor to reduce the scope to be reactive. Reactive is by exception, not by rule. Today I see that people are reactive by rule.
And I think to add to problem, the frequency of even company releases are only getting shorter. You have monthly sales and volume data now coming from a lot of industries, not just auto or the usual ones. You have now exports data, which is often misleading, but you get it on a monthly basis. So just to summarize what you said, don't see your portfolio on a daily basis, especially during market hours. It's okay if you get to know your latest net worth the next day, that's fine. The second is prefer not to have even a mobile app of trading. If at all you do, at least keep the FNO deactivated. And the last you said, even if we have a news which could be contradictory or which could be negative, sleep over it. Don't be in a hurry to react on it the very moment. At least give it a day or two of cool off. Does that summarize?
Yes, correct.
Great. I briefly wanted to talk about IPO. So back in 90s or back in 2000s, companies used to come out with primary issues to the listed space to raise growth capex, right? To raise capital to reinvest in their business. It could be for a new manufacturing plant, for R&D. Basically, money would go to the company and the shareholders would grow along. Unlike now, when majority of the IPOs are actually offer for sale. Because 10, 15, 20 years ago, these companies would have gone to some private equity or venture capital firm, raised that growth capital, and now majority of the value is created, and these existing investors are looking for an exit for which the primary market becomes a facilitation, right? So, would you say that is also one of the reasons why of late you've started looking at private markets, because a lot of value is already created before these issues hit the secondary markets?
See, there's a big difference between an IPO and a private market. In an IPO, whether it's OFS or fresh issue, a merchant banker gets the mandate for the IPO based on his ability to get a higher valuation. So the merchant banker who is able to get the best valuation gets the mandate. So it is structured to help the sellers. The buyer-seller balance itself is not fair. And the price discovery, when it is so badly tilted in favor of sellers, it doesn't make sense to be a buyer on the other side. You would rather wait for the markets to discover the price, and then you can take a fresh view of the valuation, right? That is what I feel about IPOs. Now coming to private markets. In private markets, there is no merchant banker first, where I am going. There is no investment banker. Discussion is between the management and us, two sides. So we have a team of people, investors. Management has a team of people, the CFO, founders, like that. There's a healthy discussion on why they want a particular valuation. From our side, there is a very clear explanation of what is a fair valuation and what is the valuation which works for both sides. That is how the valuation is discovered. It's definitely a far better and transparent way of discovering valuation than an IPO. And you are able to put in as much capital, certainty of deployment is also there. In IPO, you may get allotment, you may not get allotment. You may get under-allocated to the business. So it doesn't make sense to me that you go and try to get exposure or try to commit capital in a system where the odds are completely in favor of the sellers.
Sure.
That's not the case in private markets.
So a lot of...
And we get into do due diligence. That's an important point that I missed out. We have an agency who does due diligence on our behalf. We have a permanent guy whom we send to every company to to do due diligence. We have a team of people who do this, and they give a very clean report.
How have you looked upon IPOs? What are the base rates? Any word of advice to them going forward?
Very rarely, only as an exception, I find IPOs interesting. Most of the time, you have to reject IPOs. The culture should be to reject IPOs, and very rarely you should be convinced about an IPO. So that is what I think is a good defense mechanism for us.
Great. So we are almost running out of time, and we have a lot of questions from audience. We'll be able to take a couple of them, starting with this one. So somebody has asked, you showed a beautiful analogy of a clock, and you had A, B, C, D, E, F, and very categorically marked, this is the zone to sell, this is to buy, and this is not to do anything. But the question is, how do you identify where are we and where are we going?
You should do your own valuation. Constantly you should do your valuation, and you should know what is the valuation you think is attractive. See, suppose let's say you want to buy a company at 20 times, because it will keep growing at 20% and it will become cheaper with every progressive year if the price is constant. If the price comes down, it becomes more attractive. So you should be able to estimate the earnings correctly. You should not go by some very optimistic estimate. So you must estimate the earnings correctly. You must know what is the valuation you are comfortable paying. Okay, you should have a stretch valuation, where you begin. And when the valuation comes to your correct zone of comfort, you would be ready to buy more. And you will buy along the way. It should be valuation driven, it's not price driven. Sure. If you are having a good understanding of value, then you will not make this mistake. You will know that, okay, I am comfortable buying more now. And you have to keep on, thinking about the valuation continuously. You should not think about the price.
If I can add to that, Shyam, when we are at F and going towards A, and we are selling, we don't know what would be the top.
Correct.
Right? Sometimes we enter something at 15 PE, we start selling at 25 PE, thinking 13, 35 PE could be top, and for all you know, it can go to 70, 80 PE also.
Yes.
Right? So, do you also follow something called staggered selling, where you have a trailing stop loss after a point, and then from A to B, you want to sell majority, or would you be already out by the time it's A?
I have never put a stop loss in my life, but I do staggered selling. I've never used a stop loss, but staggered selling is something which works. So that by staggering itself, you think more about selling, as much about selling that you refine your thinking. And sometimes you may sell 30-40% and then stop also for more time. Sure. Then you allow the valuation to rise further, and then you sell more. You give more time basically.
Sure. This is an interesting question. It says, do you regret that if you focused on scaling your manufacturing company to a listed company over a period of time, you would have made more money and satisfaction than investing as a minority investor in others' businesses?
No, I don't regret. I was not in the right industry. Sometimes when you are in the wrong industry, you can't do it. So in the sense, I was not in the right industry at that time. So I don't have any regret about that. But he is right on saying that if you are a more entrepreneurial person, the kind of value you can create is much higher. In fact, in my private investments, I have a principle that I try to take my ownership to a significant position. Like, it should be a meaningful ownership in the company. And I accumulate a position over a period of time, so that when the IPO or whatever stage it comes, I will be able to own a larger pie of the company. I consciously do it. So I buy all the way up.
There's one question, what do you look at while investing in a private company? Because in public company, we have the whole history, whether it's business, management, valuation, you have everything. But in the private market, it's very different. Especially
you have
in startups.
history actually.
Elaborate a bit, what is the difference and what do you look at while investing in private?
No, actually private markets, when you do the due diligence or when you interact with the company, you realize that you have much better access to their data, to their history. You interview the promoters. But public market, you don't get that kind of access. You get much superior access in private markets. That's what has been my experience. So you understand the journey, where they came from, how they started, how much capital was there. The capital history is there fully with you, where the capital got built. whether they took debt to reach where they are, whether they were bootstrapped, who were the early investors, what has been the experience of the early investor, what is the equation among founders, the chemistry.
So, based on what you're saying, it seems more of qualitative aspects.
Yes.
Versus public markets where one can rely more on quantitative data because history is that much.
Yes. It's very qualitative.
So, just one last section from my side. It's a rapid fire for you, Shyam bhai. What's your favorite book, if you have to name one?
If I have to name one, I like Zurich Axioms.
Zurich Axioms. Your favorite Indian investor and why in one line?
Chandrakant Sampath.
And why?
Because I learned quality investing from him, and whatever he believed in, he remained steadfast. Many of us have gone up and down in developing our thought process, whereas whatever he gave and whatever he articulated was very steadfast, and even after his lifetime, I think it's relevant.
Your favorite promoter?
I don't really have any favorite promoter as such, but
one you appreciate the most?
I think I would appreciate Infosys the most for one fundamental reason, though I never invested in the early years. I think they set the early benchmarks in corporate governance post-liberalization. The second point which I really liked about Infosys was they always under-promised and over-delivered and did it for a very, very long period of time. I think setting expectations is such a critical part for us as investors. And while it was also a point which many people made that Infosys is deliberately setting the expectations lower, they still manage the expectations better than most Indian corporations have done in modern history.
One company where you made most money, one stock?
Sekhar Sanitary Ware.
Out of curiosity, was it like 50 bagger, 100 bagger, 200 bagger?
No, so the higher return was Hudson, but absolute money is Sekhar.
But in terms of percentage returns, you're saying it was Hudson?
I think it must have been around 40 bagger or something.
Hudson?
Sekhar.
Okay, and Hudson even more?
Even more.
Interesting. And one stock where you lost most money?
IDFC. It taught me investing.
100%?
No, I think we lost 50% in that company. IDFC, the demerger, it was a disaster.
Interesting.
I told you that I spoke that I restructured my portfolio after my friend's lunch.
Right.
My top holding
2011.
was my top holding was the two IDFC companies at that time. We thought it was defensive, hardly.
Great. Thank you so much for patiently and insightfully answering all the questions.
Thank you.